Ben Bernanke is out there trying to lay the foundation now for more QE because he knows that he can never taper. He's just bluffing. He can't tell the market the truth.
We do expect that there's going to be a taper tomorrow, correct?
Oh, we do.
You know, the market that lives by QE dies by QE. And, you know, people are starting to factor in tapering. And if the Fed tapers, this market's going a lot lower. I don't think they're going to taper. I think they're just bluffing. I think it's all talk. I think the Fed knows that they've built this phony economy, and they're going to keep inflating it. So they're going to keep talking about tapering. And they're going to talk about why they're going to do it in the future, but why they're not going to do it right now. But they're going to keep making up excuses why they can't do it. And if they actually do taper, they're going to be untapering very quickly, and that's going to be very problematic for their credibility.
Oh, my God.
Maria, I think the most amusing thing I've heard today is that the Fed is doing a fake-out on all this.
The FOMC expected to, by some at least, to taper its $85 billion monthly bond purchases by $10 billion.
Economists expect the Fed to begin cutting the $85 billion that it buys in bonds and mortgages every month by about $10 billion.
I say they'll cut the money printing by about $10 billion, moving down to $75 billion a month.
Markets expect a taper from the Federal Reserve, and actually a little bit bigger than I would have thought, but their average is $15 billion.
Participants at CNBC's Federal Reserve survey expect $14.5 billion to be taken off the table. Now, JP Morgan analysts have been the most hawkish out there. They're predicting the central bank could taper bond purchases by as much as $20 billion. Barclays, though, expects the Fed to draw back by $15 billion, 10 from Treasury purchases and 5 from mortgage-backed securities. Goldman Sachs, though, is staying in the middle of the road, predicting $10 to $15 billion worth of tapering.
I think, you know, when the Fed gets a good look at what's happening with oil prices, what's happening with stock prices going down now, real estate prices now turning south, corporate earnings going down, I think the employment picture is going to darken. I think this is another reason for the Fed not to taper, which ultimately might be what saves the market from a bigger decline, is going to be all the new inflation and the fact that the tapering talk is put back to sometime next year, and then again they'll come up with another excuse why they can't taper.
You're already seeing the anticipation of the Fed taking the training wheels off the economy.
Even though I believe the Fed's going to do more QE, and even if they make the mistake, you know, in their mind of tapering in September, which I don't think they're going to do, but even if they do that, they're going to have to undo it probably by the first quarter of 2014 and really open up the monetary spigots even further. But I don't think it's what they should do. What they should do is stop all QE, and they should start shrinking their balance sheet. But what they should do, and what I think they're going to do, are two entirely different things.
Right.
Because the Fed is going to act for political reasons, short-term expediency. They will never do what's right for the long-term health of the U.S. economy.
You know, the Fed has worked pretty hard to get to this position. That is, they've set themselves up to begin the taper. They wouldn't begin if they didn't expect they were going to be able to continue. But, you know, there may be something in the statement that surprises people. Or maybe the magnitude of the tapering will surprise people.
Federal Reserve decision. What are we getting, Steve Leisman?
No taper. The Federal Reserve did not taper. $40 billion per month in mortgage-backed securities, $45 billion per month in treasuries will continue to be purchased. The Fed says, taking into account fiscal restraint, the committee sees improvement in the economy from a year ago, but it decided to await more evidence that progress will be sustained before adjusting the purchases.
Wow, no taper. Just to reiterate here, the Federal Reserve surprising most everybody out there. Plus,
Bob Bazzani, you put out a note this morning from the floor of the stock exchange, and you're saying the tapering expectations were remarkably consistent, that pretty much everyone you spoke to was expecting a taper of like 10 to 15 billion. Now that they did not get their expectations, what are they all saying? What are they doing?
They are just shaking their heads down here. I mean, there was nobody who had zero.
I don't think they're going to taper. I think they're just bluffing. I think it's all talk.
Based on its assessment of current conditions in the outlook, which is informed by a range of indicators, including measures of labor market conditions, financial conditions, and inflation pressures, the committee now anticipates it will likely be appropriate to maintain the current federal funds rate target well past the time that the unemployment rate declines to below 6.5%, especially if projected inflation continues to run below its 2% goal. In part, this expectation reflects our assessment, based on a comprehensive set of indicators, that there will still be a substantial amount of slack in the labor market when the unemployment rate falls to 6.5%. This continuing job market slack imposes heavy costs on the unemployed and the underemployed and their families, and reduces our nation's productive capacity, warranting our ongoing highly accommodative policy. But as the last phrase of the enhanced guidance underscores, the prospects for inflation provide another reason to keep policy accommodative. The committee is determined to avoid inflation that is too low, as well as inflation that is too high, and it anticipates keeping rates low at least until it sees inflation clearly moving back toward its 2% objective. Our forward guidance is reflected in committee participants' latest projections for the path of the federal funds rate. Although the central tendency of the projected unemployment rate for the fourth quarter of next year encompasses 6.5%, 15 of 17 FOMC participants do not expect a rate increase before 2015. Most see our target for the federal funds rate as rising only modestly in 2015, while 3 do not see an increase until 2016. For all participants, the median projection for the federal funds rate is 75 basis points at the end of 2015 and 1.75% at the end of 2016. In summary, reflecting cumulative progress and an improved outlook for the job market, the committee decided today to modestly reduce the monthly pace at which it is adding to the longer-term securities on its balance sheet. If incoming information supports the committee's expectation of further progress towards its objectives, the committee is likely to reduce the pace of monthly purchases in further measured steps in future meetings. However, the process will be deliberate and data-dependent. Asset purchases are not on a preset course. The FOMC also provided additional guidance on future short-term interest rates, stating that it expects to maintain the federal funds target in its current near-zero range well past the time that the unemployment rate falls below 6.5%, especially if projected inflation continues to run below 2%. The Federal Reserve's enhanced guidance about its policy intentions and a substantial and still increasing holdings of longer-term securities will ensure that monetary policy remains highly accommodative, consistent with the pursuit of its mandated objectives of maximum employment and price